Have you ever really stopped to think about where money comes from? I'm not talking about the paper bills or the metal coins. I mean the huge, vast ocean of digital money that actually runs our world. Well, the answer isn't a government mint. It's something way closer to home. And honestly, it's a lot weirder than you think. So let's pull back the curtain on the biggest secret in modern banking. All right, first up, we need to tackle something I like to call the money illusion. It's this common idea that we all have about how banks work. But is it true? Let me ask you a question. You put $100 in the bank. What happens next? The logical answer seems to be that the bank takes your $100 and lends it out to someone else, right? They're just a middleman holding onto your cash for safekeeping. And if you said yes, you're in good company. Most people would. But right there, that's the illusion. That simple, common sense answer is just not how it works at all. The truth is a whole lot stranger, almost like a magic trick. And the crazy part is, this isn't some conspiracy hidden away in a secret vault. Nope. This happens out in the open millions of times every single day. Every time a car loan is approved, a mortgage gets signed, this is where the magic happens. Okay, enough theory, let's make this real. We're going to follow the journey of a simple $10,000 loan and watch, step by step, as this new money just appears. So you get approved for the loan. Fantastic. But now pay very close attention to what doesn't happen. Nobody goes to a vault. No armored truck shows up. The banker performs one simple action. They type numbers into a computer. And in that single keystroke, your account balance goes up by $10,000. That money was literally created out of thin air. And boom! Just like that, the total amount of money in the entire economic system has just increased by $10,000. It wasn't removed from somewhere else. It was born in that moment. This process actually has a name. It's called credit creation. And here's the most crucial part to understand. This new digital money isn't backed by gold or even by stacks of cash in the bank's vault. It's backed by one thing and one thing only: your promise. Your signature on the loan document is the foundation for that new money. But here's the flip side of that coin. As you start paying back a loan, a principal part of it, that money essentially vanishes. It's just deleted from the system. So it has a whole life cycle. Money is born from debt, and it dies when that debt is paid off. Wild, right? Okay, I know what you're thinking. How is this even possible? How could a private company just invent money? Well, it's all part of a giant global system, a machine that runs entirely on a specific set of rules and, most importantly, on trust. You know, many of us learned about something called fractional reserve banking back in school. The idea that a bank has to keep, say, 10% of your deposit and can only lend out the other 90%. Well, you can pretty much toss that idea out the window. The modern reality is the complete opposite. Banks create the loan first, they make the money appear, and then they worry about having any required reserves later. The loan is the star of the show, not your deposit. So that begs a pretty important question then, doesn't it? If that old 10% rule isn't really how it works anymore, what is the actual legally required reserve amount for banks in a major economy like the US today? Zero. That's right, a big flat 0%. Since March of 2020, the reserve requirement in the United States has been set to zero. Now, of course, banks are still regulated by other complex rules about their overall capital and risk, but that simple textbook idea of needing to hold a fraction of your deposits, it's gone. So if it's not physical cash in a vault holding all this together, what is? It's trust, confidence. That's the real fuel for our economy. It's this perpetual motion machine. As long as banks are willing to lend and people are willing to borrow, spend, and repay, the whole thing keeps humming along. But what happens when that trust starts to wobble? What happens when the gears of that machine start to grind and break down? Because this incredible system, for all its power, has one fundamental hidden weakness. And here it is. This is the core risk. The overwhelming majority of the money in our world isn't physical. It's not paper, it's not metal. It's just a bunch of digital entries on ledgers, a massive web of promises between lenders and borrowers. This is exactly what a classic bank run is. It's what happens when confidence shatters. It's when everybody shows up at once and says, okay, I want to trade in your digital promise for cold, hard cash. They quickly discover the truth. The physical cash just isn't there in those amounts. The system only works because we don't all test it at the same time. And this brings us right to why recessions are so brutal. When the economy gets shaky, banks get scared to lend and people get scared to borrow. And when that happens, that whole cycle of credit creation we just talked about, it just stops. The engine of the economy doesn't just slow down, its ability to create new money, its very lifeblood, gets choked off. So, we've seen how the machine is built, and we've seen how it can break. Let's wrap this all up because understanding this should fundamentally change how you think about the money sitting in your own account. So let's recap the big points. Number one, banks don't just move money around, they literally create it every time they issue a loan. Two, this money isn't really a thing, it's credit, a digital IOU backed by someone's debt. Three, the entire global economy is floating on a sea of confidence. And four, this system works remarkably well, right up until that confidence breaks. Look, if you take only one single idea away from all this, let it be this one. In our economy, money is get. Every dollar, every euro, every yen created by the banking system began its life as a loan. They are two sides of the very same coin. And this leaves us with one final kind of mind-bending thought to leave you with. If the money that you work for, save, and spend is fundamentally just a token that represents a debt somewhere else in the system, what does that make it? How real is it? That's something to think about.